Okay, CFA Level 1 Program Curriculum Reading 11, about sampling and estimation, learning outcomes, mastery of these. So candidates should be able to define simple random samples and sample distributions, explain sampling error, distinguish between simple random and stratified random sampling, distinguish between time series and cross-sectional data, explain the central limit theorem and its importance, calculate and interpret the standard error for of the sample mean, identify and describe desirable properties of an estimator, distinguish between a profit estimate and a confidence interval estimate of a population parameter, describe properties of student T's distribution and calculate and interpret its degree of freedom, calculate and interpret a confidence interval for a population mean, give a normal distribution with 1, known population variance, and 2, unknown population variance, or 3, an unknown population variance and a large sample size. Describe the issues regarding selection of the appropriate sample size, data mining bias, sample selection basis, survivorship bias, look-ahead bias, and time period bias. Introduction. Each day we observe the high, low, and close of stock market indexes from around the world. Indexes such as the S&P 500 and the Nikkei Dow Jones average are samples of stocks, although the S&P 500 and Nikkei do not represent the population of the US or Japanese stocks. We view them as a valid indicator of a whole population's behavior. As analysts, we are accustomed to using this sample information to assess how various markets from around the world are performing. Any statistics that we compute with sample information, however, are only estimates of the underlying population parameters. A sample then is a subset of the population, a subset studied to infer conclusions about the population itself. This reading explores how we sample the use of sample information to estimate population parameters. In the next section, we discuss sampling, the process of obtaining a sample. In investments, we continually make use of mean as a measure of central tendency of random variables, such as returns and earnings per share. Even when the probability distribution of a random variable is unknown, we can make probability statements about the population mean using the central limit theorem. In section 3, we discuss and illustrate the key results. Following the discussion, we turn to statistical estimation. Estimation seeks precise answers to the question, what is the parameter's value? The central limit theorem and estimation are the core of the body of the methods presented in this reading. In investments, we apply fees and other statistical techniques to financial data. We often interpret the results for the purpose of deciding what works and what does not work in investments. We end this reading with discussions of the interpretations of statistical results based on financial data and possible pitfalls in this process. Sampling. In this section, we present the various methods for obtaining information of a population, all members of a specific group, through samples or parts of the population, the information on the population that we try to obtain using concerns, the value of a parameter, the quantity computed from the use of to describe a population of data. When we use a sample to estimate a parameter, we make use of sample statistics. Statistics for short. The statistics is a quantity computed for use to describe a sample of data. We take samples of one of two reasons. In some cases, we cannot possibly examine every member of the population. In other cases, examining every member of the population would not be economically efficient. Thus, savings for time and money are two primary factors that cause an analyst to use sampling to answer a question about a population. In this section, we discuss two methods of random sampling, simple random sampling and stratified random sampling. We then determine and illustrate the two types of data an analyst uses, cross-sectional data and time series theta. 2.1 sampling a simple random sampling. Suppose a telecommunications equipment analyst wants to know how much major consumers will spend on average for equipment during the coming year. One strategy is to survey the population of telecom equipment consumers and inquire what their purchase plans are. In stratified terms, in statistical terms, the characteristics of the population of customers' planned expenditures would then usually be expressed by descriptive measures such as the mean and variance. Surveying all companies, however, would be very costly in terms of time and money. Alternatively, the analyst can connect a representative sample of companies and survey them about upcoming telecom equipment expenditures. In this case, the analyst will compute the sample mean expenditure or the X bar of statistics. The strategy has a substantial advantage over polling the whole population because it can be accomplished more quickly and at a lower cost. Sampling, however, introduces errors, and errors arise because not all the companies in the population are surveyed. The analyst who decides to sample is trading time and money for sampling error. When an analyst chooses to sample, he must formulate a sampling plan. A sampling plan is the set of rules used to select a sample, the basic type of sample from which we can draw statistics. Sound conclusions about a population is the simple random sample, or random sample for short definition of simple random sample. A simple random sample is a subset of a larger population created in such a way that each element of the population has an equal probability of being selected to the subset. The procedure for drawing a sample to satisfy the definition of a simple random sample is called the simple random sampling. How is a simple random sampling carried out? We need a method that ensures randomness, the lack of any pattern, and this selection of random sample involves the use of random numbers with assured probabilities of randomness. First, we number the member of the population in sequence. For example, if the population contains 500 members, we need them in sequence with 3 digits, starting with 001 and ending with 500. Suppose we want a simple random sample of size 50. In that case, using a computer random number generator or a table of random numbers, we generate a series of 3-digit random numbers. We then match these random numbers with the number codes of the population number until we have selected a sample size of 50. Sometimes we cannot code or even identify all the members of a population. We often use systematic sampling in such cases. With systematic sampling, we select every KF number until we have a sample of the desired size. The sample that results from this procedure should be approximately random. Real sampling situations may require that we take an approximately random sample. Suppose the telecommunication equipment analyst pulls a random sample of telecom equipment customers to determine the average equipment expenditure. The sample mean will provide the analyst with an estimate of the population mean expenditure. Any difference between a sample mean and a population mean is called sampling error. A definition of sampling error. Sampling error is a difference between the observed value of a statistic and quantity, and it is intended to estimate. A random sample reflects the probabilities of the population in its unbiased way. The sample statistics, such as the sample mean, are computed on the basis of a random sample. A sample statistics is a random variable. In other words, not only do the original data from the population have a distribution, but so does the sampling statistics. The distribution is the statistics sampling distribution. Definition of sampling distribution of a statistic. The sampling distribution of a statistics is the distribution of all the distinct possible values that the statistics can assume when computed for samples of the same size randomly drawn from the sample population. In the case of the sample mean, for example, we refer to sample distributions of the sample mean or the distribution of the sample mean. We will have more to say about sampling distributions later in this reading. Next, however, we look at another sampling method that is useful in investment analysis. 2.2 Stratified random sampling. The simple random sampling method just discussed may not be the best approach in all situations. One frequently used alternative in stratified random sampling, as the definition of stratified random sampling is, in stratified random sampling, the population is divided into subpopulations or stratas based on one or more classification criteria. Sampling randoms, simple random samples are then drawn from each stratum in size proportional to the relative size of the stratum in the population. These samples are then pooled to form the stratified random sample. In contrast to simple random sampling, stratified random sampling guarantees that populations subdivisions of interest are represented in the sample. Another advantage is the estimates of parameters produced from stratified sampling have greater precision, that is, smaller variance or dispersion than estimates obtained from simple random sampling. Okay. Bond indexes is one area in which stratified sampling is frequently applied. Indexing an investment strategy in which an investor constructs a portfolio to mirror the performance of a specified index. In pure bond indexing, also called the full replication approach, the investor attempts to fully replicate an index by owning all the bonds in the index in proportion to the market value weights. Many bonds index consists of thousands of issues. However, so pure bonds indexing is difficult to implement. In addition, transaction costs will be high because many of these bonds do not have liquid markets. Although a simple random sample could be a solution to the cost problem, the sample would probably not match the index's major risk factors. Interest rate sensitivity, for example, because the major risk factors for fixed income portfolios are well known and quantifiable. Stratified sampling offers a more effective approach. In this approach, we divide the population of index bonds into groups of similar durations, interest rate sensitivity, cash flow distribution sector, credit quantity, and call exposure. We refer to each group as a stratum, or called a term frequently used in the context. Then we choose a sample from each stratum proportional to the relative market weighing of the stratum in the index to be replicated. Example 1, bond index and stratified sampling. Suppose you are a manager at a mutual fund index at Lehman Brothers. Lehman Brothers. Lamau. Imagine when Lehman Brothers was still around. Government index. You are exploring several approaches to indexing, including stratified sampling approach. You first distinguish agency bonds from U.S. Treasury bonds for each of these two groups. You define 10 maturity intervals, 1 to 2 years, 2 to 3 years, 3 to 4 years, 4 to 6 years, blah, blah, blah. And lastly, 20 to 30 years. And also separate the bonds with coupons or annual interest rates of 6% or less from the bonds with coupons of more than 6%. How many cells of strata does the sampling plan entail? If you use the sampling plan, what is the minimum number of issues that an index portfolio can have? Suppose that in selecting among the securities that qualify for selecting within each cell, you apply a criterion concerning the liquidity of the securities market. In the sample obtained random. Is the sample obtained random? Explain your answer. Solution to 1. We have 2 issuer classifications, 10 maturity classification, and 2 coupon classification. So in total, the plan entails 10 multiplied by 2 multiplied by 2 multiplied by 10 multiplied by 2, which is 40 different strata or cells. The answer is an application of the multiplication rule, counting discussed in the reading of probability concepts. Solution to 2, you cannot have fewer. Oh yeah, we're on page 600. Finally, past the 500 mark. Okay, you cannot have fewer than 1 issuer for each cell, so the portfolio must include at least 40 issues. Solution to 3, if you apply any additional criteria to the selection of securities for the cell, not every security that might be included has an equal probability of being selected. As a result, the sampling is not random. In practice, indexing Using stratified sampling usually does not strictly involve random sampling because the selection of bond issues within cells is subject to various additional criteria. Because the purpose for sampling in this approach is not to make an inference about a population parameter, but rather to index a portfolio. Lack of randomness is not in itself a problem in this application of stratified sampling. In this next section, we will discuss the kinds of data used by financial analysts in sampling, the practical issues that arise in selecting samples. 2.3 time series and cross-sectional data. Investment analysts commonly work with both time series and cross-sectional data. Time series is a sequence of returns collected at discrete and equally spaced intervals of time, such as a historical series of monthly stock returns. Cross-sectional data are data on some characteristic of individual group or geographic region or companies at a single point in time. The 2014 and a year-end book value for a share for all New York Stock Exchange listed companies is an example of cross-sectional data. Economic or financial theory offers no basis for determining whether a long or short-term period should be selected to collect a sample and analysis. As analysts, we might have to look for subtle clues. For example, combining data from a period of fixed exchange rates with data from a period of floating exchange rates will be inappropriate. The variance of exchange rates when exchanging rates where fixed would certainly be less than when rates were allowed to float. As a consequence, we would not be sampling from a population described by a single set of parameters. Tight versus loose monetary policies also influences the distribution of returns to stocks. Thus, combining theta from tight money and loose money periods would be inappropriate. Example 2 illustrates the problem that can arise when sampling from more than one distributions. Example 2, calculating Sharpe ratios, 1 or 2 year or quarterly data. Analysts often use the Sharpe ratio to evaluate the performance of a managed portfolio. The Sharpe ratio is an average return of the excess of the risk-free rate divided by the standard deviation of returns. This ratio measures the excess return earned per unit of standard deviation of return. To compute the Sharpe ratio, suppose that an analyst collects 8 quarterly excess returns, i.e. total return in access to the risk-free rate. During the first year, the investment manager of the portfolio followed a low-risk strategy, and during the second year, the manager followed a high-risk strategy. For each of those years, the analyst also tracked the quarterly access returns of some benchmark against which the manager will be evaluated. So here's the quarter-year returns. For the first year during which the manager followed a lower strategy, the average quarterly return in excess of the risk-free rate was 1%, with the standard deviation of 4.62%. The Sharpe ratio is 1 divided by 4.26 and 0.22. The second year results mirrors the first year, except in the higher average return and volatility. The Sharpe ratio in the second year is 0.22. The Sharpe ratio for benchmark is 0.21 during the first and second year, because larger Sharpe ratios are better than smaller ones, providing more returns per unit for risk. The manager appears to have outperformed the benchmark. Now suppose the analyst believes a larger sample to be superior to a small one. She thus decides to pool 2 years together and calculate Sharpe ratio based on 8 quarterly observations or 2 years of observations. The average quarterly access return for the 2 years is the average of each year's average access return for the 2-year period. The average access return is 1 plus 4 divided by 2, which is 2.5% per quarter. The standard deviation for 8 quarters measured in a Sharpe measure is 2.5%, is 12.57%. The portfolio's Sharpe ratio for the 2-year period is therefore 0.199. The Sharpe ratio for the benchmark remains 2.2 to 1. Thus, when returns for the 2-year period are pooled, the manager appears to have provided less return per unit of risk than the benchmark and less when compared with the separate yearly results. The problem with using 8 quarters of return data is that the analyst has violated the assumption that the sample returns come from a sample population as a result of the change in the manager's investment strategy. Returns in year 2 followed a different distribution than returns in year 1. Clearly, during year 1, returns were guaranteed by an underlying population with lower mean and variance than a population of the second year, combining the results from the first and second year, yielding a sample that was representative of no population. Because the lower sample did not satisfy model assumptions. Any calculation the analyst reached based on a larger sample are incorrect. For this example, she was better off using a smaller sample than a larger sample because the smaller sample represented a more homogeneous distribution of returns. The second basic type of data is cross-sectional data. With cross-sectional data, the observation in this sample represents a characteristic of individual group, geographic region, or companies at a single point in time. The telecommunications analyst discussed previously is essential for collecting a cross-section of planned capital expenditure for the coming year. Whenever we sample cross-sectionally, certain assumptions must be met if we wish to summarize the data in a meaningful way. Again, a use approach is to Again, a useful approach is to think of the observations of interest as a random variable that comes from some underlying population with a given mean and variance. As we collect our sample and begin to summarize the data, we must be sure that all the data do in fact come from the same underlying population. For example, an analyst might be interested in how efficiently companies use their inventory assets. Some companies, however, turn over the inventory more quickly than others because the difference in operating environments, e.g. grocery stores, turn over inventory more quickly than automobile manufacturers in general. So the distribution of inventory turnover rates may not be characterized by a single distribution with a given mean and variance. Therefore, summarizing inventory turnover access all companies might be inappropriate. If random variables are generated by different underlying distributions, the sample statistics computed from combined samples are not related to one underlying population parameter. The size of the sampling error in such cases is unknown. In instances such as these, analysts often summarize company-level data by industry. Attempting to summarize by industry partially addresses the problem of one industrial sector, so analysts should be sure that they understand how companies are assigned in the industrial groups. Whether we deal with time series data or cross-sectional data, we must be sure to have a random sample that is representative of the population we wish to study. With the objective of inferring information from representative samples, we now turn to the next part of this reading with focuses on the central limit theorem, as well as point and interval estimates and population mean. Okay, I'll continue reading this part as well. Distribution of the sample mean. Earlier in this reading, we presented the telecommunication equipment analyst who decides to sample in order to estimate mean planned capital expenditure by his customers. Suppose that the sample of his representative of the underlying population. How can the analyst assess the sample error in estimating the population mean? View as a formula that takes a function and a random outcome of the variable. The sample mean itself is a random variable with a population distribution. The probability distribution is called the statistics sampling distribution. To estimate how closely the sample mean can be expected to match the underlying population mean, the analyst needs to understand the sample distribution of the mean. Fortunately, we have a result, the central limit theorem, that helps us understand the sample distribution of the mean and many of the estimation problems we face. 3. The central limit theorem. One of the most practically useful theorems in probability theory, the central limit theorem has important implications for how we construct confidence intervals and test hypotheses. Formally, it is stated as follows: the central limit theorem, given a population described by any probability distribution having mean, mu, and finite variance of of variance or standard deviation squared. The sample distribution of sample mean x bar, or the mean of x, or the mu of x, computed from sample size of n from the population will be approximately normal with mean mu, the population mean, and variance divided by n. The the population variance divided by n when the sample size n is large. The central limit theorem allows us to make quite precise probability statements about the population mean by using the sample mean, whatever the distribution of the population, as long as it has a finite variance. Because the sample mean follows the approximate normal distribution for large size samples, the obvious question is when is a sample size large enough that we can assume that sample mean is normally distributed in general. When sample size n is greater than or equal to 30, we can assume that the sample mean is approximately normally distributed. The central limit theorem states that the variance of the distribution of the sample mean is variance divided by n. The positive square root of variance is a standard deviation. The standard deviation of a sample statistics is known as the standard error of the statistics. The standard error of the sample mean is an important quantity in applying the central limit theorem in practice. Definition of standard error and sample mean. And for a sample mean x bar calculated from a sample generated by population with standard deviation, the standard error for the sample mean is given by one of the two expressions, the standard deviation for x bar of the sample. So standard deviation for the sample is divided by the standard deviation divided by the number of trials with a square root. We know that standard deviation, the population and standard deviation, or by this. And when we do not know the population standard deviation, we need to use the sample standard deviation S to estimate it. In practice, we almost always need to use equation 2. The estimate of S is given by the square root of the sample variance of S squared, calculated as followed. We will soon see how we could use the sample mean and its standard error to make probability statements about the population mean by using the technique of confidence intervals. First, however, we provide an illustration of the central limit theorem of force. Example 3, the central limit theorem. It is remarkable that a sample mean for large sample sizes will be distributed normally regardless of the distribution of the underlying population. The illustration of the central limit theorem in action, we specify in some examples of distinctly non-normal distributions and use it to generate a large number of random samples of size 100. We then calculate the sample mean of each sample. The frequency distribution of the calculation sample mean is an approximation of the sampling distribution of the sample mean for the sample size. Each of the sampling distributions look like a normal distribution. Does the sampling distribution look like a normal distribution? We return to the telecommunications analyst studying the capital expenditure plan of telecommunication business. Suppose the capital expenditure for communication equipments from a continuous uniform random variable with a lower bound equals to $0 and an upper bound equal to $100 for short. Call this a uniform 0-1 random variable. The probability function of this continuous uniform random variable has a rather simple sharp that is anything but normal. It is a horizontal line with a vertical intercept equal to 1 divided by 100, unlike a normal random variable for which outcomes close to the mean are most likely. All possible outcomes are equally likely for a uniform random variable. To illustrate the power of the central limit theorem, we conduct a Monte Carlo simulation to study the capital expenditure plans of telecom businesses. In this simulation, we collect 200 random samples of the capital expenditures of 100 companies, 200 random draws. Each consists of the capital expenditure of 100 companies with n equals 100. In each situation trials 100 values of capital expenditures are generated from the uniform 0-100 distribution for each random sample. We then compute the sample mean. We conduct 200 simulation trials in total. Because we have specified the distribution generating the samples, we know that the population mean capital expenditure is equal to 0 plus 100 million divided by 2, which is 50 million. The population variance of capital expenditure is equal to 833.33. Thus, the standard deviation is 28.87 million, and the standard deviation is this. Okay. To summarize, according to the central limit theorem, when we sample from any distribution, the distribution of the sample mean will have the following properties. As long as our sample size is large, the distribution of the sample mean x bar will be approximately normal. The mean of the distribution x bar will be equal to the mean of the population from which the sample is drawn. The variance of distribution of x bar will be equal to the variance of the population divided by the sample size. We next discuss the concept of tools related to estimating the population parameters. With a special focus on the population mean. We focus on the population mean because analysts are more likely to meet interval estimates for the population mean than any other type of interval estimate. Okay, so next we have the point and interval estimates of the population mean. I do hope my readings up to this point to reading 11 of CFA Level 1 program curriculum has been helpful, and I hope to see you guys in the next one. Goodbye. Continued CFA reading, level 1. Reading 11, part 4, points and interval estimates of the population mean. Statistical inference traditionally consists of two branches, hypothesis testing and estimation. Hypothesis testing addresses the question, is the value of the parameter, say a population mean, equal to some specific value, 0? For example, in this process, we have a hypothesis concerning the value of a parameter, and we seek to determine whether this evidence, whether the evidence for a sample supports or does not support the hypothesis. We discuss hypothesis testing in detail in the reading on hypothesis testing. The second branch of statistical inference and the focus of this reading is estimation. Estimation seeks to answer the question, what is the parameter? For example, the population mean's value. In estimating, unlike in hypothesis testing, we do not start with hypothesis about a parameter's value and seek to test it. Rather, we try to make the best use of the information in a sample to form one of several types of estimates of the parameter's value. With estimation, we are interested in arriving at a rule for best calculation, for best calculating a single number of estimate, the unknown population parameters, a point estimate together with calculating a point estimate. We may also be interested in calculating a range of values that brackets the unknown population parameters with a specific level of probability, a confidence interval. In section 4.1, we discuss point estimates of parameters, and then in section 4.2, the formulation of confidence intervals for the population mean. 4.1 with the point estimators. An important concept introduced in this reading is that sample statistics viewed as formulas involving random outcomes are random variables. The formulas that we used to compute a sample mean and all other sample statistics are examples of estimation formulas or estimators. The particular value that we calculate for sample observations using estimator is called an estimate. An estimator has a sampling distribution. An estimate is a fixed number number pertaining to a given sample and thus has no sampling distribution. To take the example of the mean, the calculated value of the sample mean in a given sample used as an estimate of the population mean is called a point estimate. With the population mean, as example 3 illustrated, the formula for the sample mean can and will yield different results in repeated samples, as different samples are drawn from different population from the population. In many applications, we have a choice among a number of possible estimators for estimating a given parameter. How do we make our choice? We often select estimators because they have one or more desirable statistical properties. Following is a brief description of the three desirable properties of estimators: unbiasedness, lack of bias, efficiency, and consistency. Definition of unbiasedness. An unbiased estimator is one whose expected value, or the mean of its sampling distribution, equals the parameter it is intended to estimate. For example, the expected value of a sample mean x bar equals mu, the population mean. So we say that the sample mean is an unbiased estimator of the population mean. The sample variance S squared, which is calculated using a divisor of n minus 1, or equation 3, is an unbiased estimator of the population variance of this. If we were to calculate the sample variance using a divisor of n, the estimator would be unbiased. Its expected value would be smaller than the population variance. We would say that sample variance calculated with a divisor of n is a biased estimator of the population variance. Whenever one unbiased estimator of a parameter can be found, we can usually find a large number of other unbiased estimators. How do we choose among alternative unbiased estimators? The criteria of efficiency provides a way to select from among unbiased estimators of a parameter. Definition of efficiency: an unbiased estimator is efficient if no other unbiased estimator of the same parameter has a sample distribution with a smaller variance. To explain the definition, in repeated samples with expected estimates from an efficient estimator to be more tightly grouped around the mean, the estimates from other unbiased estimators. Efficiency is an important property of an estimator. A sample mean x bar is an efficient estimator of the population mean. A sample variance of S squared is the efficient estimator of a standard deviation squared. Recall that a statistics sampling distribution is defined for a given sample size. Different sample sizes define different sample distributions. For example, the variance of sampling distribution of a sample mean is smaller than for larger sample sizes. Unbiasedness and efficiency are probabilities of an estimator's sampling distribution that holds for any sample size. An unbiased estimator is unbiased equally in a sample of size 10 as it is of size 1,000. In some problems, however, we cannot find estimators that have such desirable properties of unbiasedness in small samples. In this case, statisticians may justify the choice of an estimator based on the property of the estimator's sampling distribution of extremely large samples. The estimator's so-called isentropic properties. Among such properties, the most important are consistency. A definition of consistency: a consistent estimator is one for which the probability of estimates close to the value of the population parameter increases as sample size increases. Somewhere more technically, we can define a consistent estimator as an estimator whose sample distribution becomes concentrated on the value of the parameter it is intended to estimate as the sample size approaches infinity. The sample mean, in addition to being an efficient estimator, is also a consistent estimator of the population mean. A sample size n goes to infinity. As sample size n goes to infinity, its standard error, standard deviation divided by the square root of n goes to 0. That's because it gets closer to 1. What? That doesn't make any sense. Let me keep reading. And the sample distribution becomes concentrated right over the value of population mean. Population mu. To summarize, we could think of the consistent estimator as one that tends to produce more and more accurate estimates of the population parameter as we increase the sample's size. If an estimator is consistent, we may attempt to increase the accuracy of estimates of a population parameter by calculating estimates using a larger sample. For an inconsistent estimator, however, increasing sample size does not help to increase the probability of accurate estimates. 4.2 confidence interval for population mean. Then we need a single number of an estimate of a population parameter. We make use of a point estimate, however, because of sampling errors, the point estimate is not likely to equal the population parameter in a given sample. Often a more useful approach than finding a point estimate is to find a range of values that we expect to bracket the parameter with a specific level of probability and interval estimate of the parameter, a confidence interval fulfills this role. Definition of confidence interval. A confidence interval is a range for which one could assert with a given probability 1 minus this is the degree of confidence, called the degree of confidence, that it will contain the parameters it is intended to estimate. The interval is often referred to as 100% multiplied by 1 minus degree of confidence percentage. Confidence interval of the parameter. The endpoint of the confidence interval are referred to as the low and upper confidence limits. In this reading, we are concerned only with two-sided confidence intervals for which we calculate both lower and upper limits. Confidence intervals often frequently given either a probabilistic interpretation or a practical interpretation. In the probabilistic interpretation, we interpret a 95% confidence interval for the population mean as follows. In representing sample of 95% of such confidence intervals will in the long run include a bracket or bracket the population mean. For example, suppose we sample from a population of 1,000 times the based on each sample, we construct 95% confidence intervals using the calculated sample mean. Because of random chance, these confidence intervals will vary from each other, but we expect 95% or 950 of these intervals to include the unknown value of the population mean. In practice, we generally do not carry out such repeated sampling. Therefore, in a practical interpretation, we assert that we are 95% confident that a single 95% confidence interval contains the population mean. We are justified in making this statement because we know that 95% of all possible confidence intervals constructed in the sample in the same manner will contain the population mean. The confidence interval that we discuss in this reading have structures similar to the following basic structure. Construction of confidence interval. A100 is multiplied by 1 minus the confidence interval percent, which is the confidence interval for a parameter that has the following structure. Point estimate plus or minus reliability factor multiplied by standard error, where point estimate equals the point estimate of a parameter, a value of a sample statistic. Reliability factor, a number based on the assumed distribution of the point estimate and the degree of confidence, 1 minus the confidence of interval. Standard error is the sampling. The sample error of the sampling statistic providing the point estimate. The most basic confidence interval for the population mean arises when we are sampling from a normal distribution. We know with known variance the reliability factor in this case is based on the standard normal distribution, which has a mean of 0 and a variance of 1. A standard normal random variable is conventionally denoted by Z. The notation ZA denotes the point of a standard normal distribution such as A of the probability remains in the right tail. For example, 0.05 or 5% of the possible values of a standard normal random variable are larger than Z, 0.05 or 1.65. Suppose we want to construct a 95% confidence interval for the population mean, and for this purpose we have taken a sample of size 100 from a normally distributed population with known variance of standard deviation squared of variance equals to 400, so standard deviation equals 20. We calculate a sample mean of x bar equals 25. Our point estimate of the population mean is therefore 25. If we move 1.96 standard deviations from the mean of the normal distribution of 0.025 or 2.5% of the probability remains in the right tail by symmetry of normal distribution. If we move 1.96 standard deviation below the mean, or 22.5% of the probability remains in the left tail, and total 0.05 or 5% of the probability is in the two tails, and 0.95 or 95% lies between. So z of 0.2025 equals 1.96 is the reliability factor for this 95% confidence interval. Note that the relationship 100 multiplied by 1 minus 8% for the confidence interval, and the ZA divided by 2. For the reliability factor, the standard error of the sample mean given by equation 1 is this. The confidence interval therefore has a lower limit of this. The upper limit of the confidence interval is this. The 95% confidence interval for the population mean spans 21.08 to 28.92. Confidence intervals for the population mean or normally distributed population with known variance. It looks like this. Reliability factor for confidence interval based on the standard normal distribution. We use the following liability factors when we construct confidence intervals based on standard normal distribution. 90% confidence intervals use z 0.05 equals 1.65. 95% confidence interval uses z 0.25 equals 1.95. 99% confidence interval uses this. These reliability factors highlight an important fact about all confidence intervals. As we increase the degree of confidence, the confidence interval becomes wider and gives us less precise information about the quality we want to estimate. The surer we want to be, the less we have to be sure of. In practice, the assumption that the sampling distribution of a sample mean is at least approximately normal and frequently reasonable is frequently reasonable, either because the underlying distribution is approximately normal or because we have a large sample and a central limit therein applies. However, rarely do we know the population variance in practice. When the population variance is unknown, but the sample mean is at least approximately normally distributed, we have two acceptable ways to calculate the confidence interval for the population mean. We will soon discuss the more conservative approach, which is based on student T's distribution. The T distribution for short, the investment literature. In investment literature, it is most frequently used to approach in both estimation and hypothesis testing concerning the mean. When the population variance is not known, whether sampling size is small or large. The second approach to confidence intervals for the population mean based on the standard normal distribution is the Z alternative. It can be used only when sample size is large. In general, a sample size of 30 or larger may be considered large. In contrast to the confidence interval given in equation 4, this confidence interval uses the sample distribution of S in computing the standard error of the sample mean. Equation 2, confidence interval for population mean. The Z alternative or large sample population variance unknown. So that looks like this. Because the type of confidence interval appears quite often, we illustrate the calculation in example 4. Okay, confidence intervals for population mean of Sharpe ratio with Z statistic. Suppose an investment analyst takes a random sample of U.S. equity mutual funds and calculates the average Sharpe ratio. the sample size of 100 and the average sharp ratio of 0.45. So the mu is 0.45 for the population. The sample has a standard deviation of 0.3. Calculate and interpret the 90% confidence interval for the population mean of all U.S. equity mutual funds by using a reliability factor based on the standard normal distribution. The reliability factor for 90% confidence interval, as given earlier, is Z0.05 or 1.65. The confidence interval will be this. The confidence interval spans 0.4005 or 0.4995 or 0.4 and 0.5, carrying 2 decimal places. The analyst can say with 90% confidence that the interval includes the population mean. In this example, the analyst makes no specific assumption about the probability distribution of the population. Rather, the analyst relies on the central limit theorem to produce an estimate normal distribution for the sample mean. In example 4, as example 4 shows, even if we are unsure of the underlying population distribution, we could still construct confidence intervals for the population mean as long as the sample size is large, because we can apply the central limit theorem. Structuring confidence intervals for population mean when the population variance is unknown. For confidence intervals based on sample size from normally distributed populations with unknown variance, the theoretically correct reliable factor is based on the t distribution. Using a reliable factor based on the t distribution is essential for small sample sizes. Using a t reliability factor is appropriate when the population variance is unknown, even when we have a large sample, and could use the central limit theorem to justify using t reliability factor. In this large sample case, the t distribution provides more conservative, wider confidence intervals. The t distribution is a symmetrical probability distribution defined by a single parameter known as degrees of freedom, or df. Each value for the number of degrees of freedom defines one distribution is the family of distributions. We will shortly compare t distributions with the standard normal distribution. But first, we need to understand the concept of degrees of freedom. We can do so by examining and calculating for the sample variance. Equation 3 gives the unbiased estimator of the sample variance that we use. The term in the denominator n-1, which is the sample size minus 1, is the number of degrees of freedom in estimating the population variance when using equation 3. We use n-1 as number of degrees of freedoms for determining reliability factors based on the t distribution. The term degrees of freedom is used because in a random sample, we assume that observations are selected independently of each other. The numerator of the sample variance, however, uses sample mean. How does the use of sample mean affect the number of observations collected independently for the sample variance formula? With a sample size of 10 and a mean of 10%, for example, we could freely select only 9 observations regardless of 9 observations selected. We can always find a value of the 10th observation that gives the mean equation of 10%. From the standpoint of the sample variance formula, then, there are 9 degrees of freedom. Given that we must first compute the sample mean from the total of n independent observations, and n-1 observations can be chosen independently from the calculations of the sample variance. The concept of degrees of freedom comes up frequently in statistics, and you will see it often in later readings. Suppose we sample from a normal distribution. The ratio z equals x bar minus mu divided by standard deviation divided by n square root of n. is distributed normally with the mean of 0 and standard deviation of 1. However, the ratio t equals x bar minus mu divided by s divided by square root of n follows the t distribution with mean 0 and n minus 1 degrees of freedom. The ratio represented by t is not normal because t is the ratio of two random variables. The sample mean of the standard variance, the sample standard deviation, the definition of the standard normal random variable involves only one random variable. The sample mean as degrees of freedom increases, however, the t distribution approaches the standard normal distribution. Figure 1 shows the standard normal distribution and two distributions, one with df equals 2 and one with df equals 8. Students, t distribution versus a standard normal distribution. One of three distributions shows in figure 1. The standard normal distribution has tails that approaches 0 faster than tails with two distributions. The t distribution is also statistically distributed around the mean value of 0, just like the normal distribution. As the degree of freedom increases, the t distribution approaches the standard normal. The t distribution with df equals 8 is closer to the standard normal than t distribution with df equals 2. Beyond plus and minus 4 standard deviation from the mean, the area under standard normal distribution appears to approach 0. Both t distributions continue to show some area under each curve beyond 4 standard deviations. However, the t distribution has fatter tails. But the tails of the t distribution with df equals 8 more closely resembles the normal distribution's tail. As the degree of freedom increases, the tails of the t distribution becomes less flat. Frequently referred to values for t distributions are presented in the table at the end of the book. For each degree of freedom, 5 values are given: t0, 10, t005, t025, and this. You get confidence intervals for population mean, for population variance, unknowns for the t distribution. If we are sampling from a population with unknown variance and either the conditions are held, the sample size are large, or the sample is small but the population is normally distributed or approximately normally distributed, then 100 multiplied by 1 minus a, 100% percentage of confidence intervals for the population mean, mu, is given by this formula, where the number of degrees of the freedom is this. Example 5 represents the data for example of example 4, but uses t statistics rather than the z statistics to calculate a confidence interval for the population mean of a Sharpe ratio. Example 5, confidence interval for population mean of a Sharpe ratio t statistics. As in example 4, an investment analyst seeks to calculate a 90% confidence interval for the population mean Sharpe ratio of U.S. equity mutual funds based on a random sample of 100 U.S. equity mutual funds. The sample mean Sharpe ratio is 0.45. And a sample standard deviation of the Sharpe ratio is 0.3. Now recognizing that a population variance of the distribution of Sharpe ratio is unknown, the analyst decides to calculate the confidence interval using the theoretically correct t statistic. Because sample size of 100 is 100, df equals 99. In the tables in the back of the book, the closest value of df 100 using df 100 reading down to 0.05 column, we used to find that t 0.05 equals 1.66. This reliability factor is slightly larger than a reliability factor of z equals 0.05, which is 1.65%. That was used in example 4, the confidence interval. The confidence interval will be x bar equals 0.45 plus or minus 0.498. 0.0498. The confidence interval spans 0.0498 to 0.4998 or 0.4 to 0.5, carrying 2 decimal places. 2 decimal places, the confidence interval is unchanged from one computed from the one computed in example 4. Table 3 summarizes the various reliability factors that we have used. Table 3 is the basis of computing reliability factors. Sampling form normal distributions as with known variance with the sample size of this and this. 4.3 selecting a sample size. What choices affect the width of the confidence interval? To this point, we have discussed 2 factors that affect the width. The choice of statistics t to z and the choice of degrees of confidence, affecting which specific value of t or z we use. These 2 choices determines the reliability factor. Recall that the confidence interval has the structure point estimate plus or minus reliability factor multiplied by standard error. The choice of sample size also affects the width of a confidence interval. All else equal, a larger sample size decreases the width of the confidence interval. Recall the expression for standard error and the standard mean. Standard error of the sample mean equals a sample of standard deviation divided by the square root of the sample size. We see that the sample error varies inversely with the square root of the sample size. As we increase the sample size, the standard error decreases, and consequently the width of the confidence interval also decreases. The larger the sample size, the greater precision with which we can estimate the population parameter. All else equal, larger samples are good in that sense. In practice, however, 2 considerations may operate against increasing sample size. First, as we saw in example 2 concerning the Sharpe ratio, increasing the size of a sample may result in sampling from more than one population. Second, increasing sample size may involve additional expression that outweighs the value of additional precision. Thus, 3 issues that the analysts should weigh in selecting sample size are the need for precision, the risk of sampling from more than one population, and the expense of different sample sizes. Sample 6, money managers estimate net client inflows. A money manager who wants to obtain a 95% confidence interval for fund inflows and outflows over the next 6 months has his existing clients. He begins by calling a random sample of 10 clients and inquiring about their planned additions to the withdrawals of the fund. The manager then computes the changes in cash flow for each client sampled as a percentage change in total fund placed. With the manager, a positive percentage change indicates a net cash flow to the client's account. A negative percentage change indicates a net cash flow from net cash outflow from the client's account. The manager weighs each response by the relative size of the account within the sample and then computes the weighted average. As a result of the process, the money manager computes a weighted average of 5.5%. Thus, a point estimate is that the total amount of fund under management will increase by 5.5% in the next 6 months. The standard deviation of the observations is the sample of 10%. A histogram of past data looks fairly close to normal, so the manager assumes the population is normal. Calculate a 95% confidence interval for the population and mean for the interpret your findings. The manager decides to see what the confidence interval would look like for the if he had used a sample size of 20 or 30 and found the mean of 5.5% and standard deviation of 10%. Using the sample mean of 5.5% and standard deviation of 10% computes the confidence intervals for sample sizes 20 and 30. For these samples of 30, use equation 6. Interpret your results from parts 1 and 2. Solution to 1. Because your population variance is unknown and the sample size is small, the manager must use the t-statistics in equation 6 to calculate the confidence interval. Based on the sample size of 10, df equals n minus 1, 10 minus 1 equals 9. For 95% confidence interval, he needs to use the value of t equals 0.025 or df equals 9 according to the table in Appendix B. At the end of this value, the value of 2.262. Therefore, a 95% confidence interval for the population mean is around this. The confidence interval for the population mean spans negative 1.65% to positive 12.65%. The manager can be confident with 95% levels that this range includes the population mean. Solution to 2. Table 2 gives the calculation for 3 sample sizes. So that's solution to 2. Solution to 3. The width of the confidence interval decreases as we increase the sample size. This decrease is a function of the standard error becoming smaller. As n increases, the reliability factor also becomes smaller as the number of degree of freedoms increases. The last column of table 4 shows the relative size of the width of the confidence interval based on n equals 0 to be 100%. Using a sample size of 20 reduces the confidence interval to width of 65.5% of the interval width for the sample size of 10. Using a sample size of 30 cuts the width of the interval almost in half. Comparing those choices, money managers will obtain the most precise results using a sample size of 30. So 30 is the magical number, really. Having covered many of the fundamental concepts of sampling and estimation, we are in a good position to focus on sampling issues of special concerns to analysts. The quality of inference depends on the quality of the data as well as the quality of the sampling plan used. Financial data poses special problems. The sampling plans frequently reflects one or more biases. The next section of this reading discusses these issues. Part 5, Reading 11, more on sampling. We have already seen that the selection of sample period length may raise the issue of sampling from more than one population. That is, in fact, a range of challenges to valid sampling that arises in working with financial data. In this section, we discuss four such sampling-related issues: data minus biases, sampling selection biases, look-ahead biases, and time period biases. All of these issues are important for point and interval estimations and hypothesis testing. As we will see, if the sample is biased in any way, then point and interval estimates and any other conclusions that we draw from the sample will be in error. Data mining biases. Data mining relates to overuse of the same or related data in ways that we shall describe shortly. Data mining biases refers to the error that arises from such misuse of data. Investment strategies that reflect data mining biases are often not successful in the future. Nevertheless, both investment Practitioners and researchers have frequently engaged in data mining. Analysts thus need to understand and guard against this problem. Data mining is the practice of determining a model by extensive searching through a data set for statistically significant patterns, like repeating drilling in the same data until finding something that appears to work. In exercise involving statistical significance, we set a significant level, which is the probability of rejecting the hypothesis. When we are testing with the hypothesis is the fact correct? Because rejecting a true hypothesis is undesirable, the investigator often sets a significant level at a relatively small number, such as 0.05 or 5%. Suppose we test the hypothesis that a variable does not predict stock return, and we test the return of 100 different variables. Let us also suppose that the truth none of the 100 variables have the ability to predict stock returns. Using a 5% significance level in our test, we will still return. We will still expect 5 out of 100 variables will appear to be significant predicators of stock returns because of random chance alone. We have mined the data to find some apparent significant variable. In essence, we have explored the same data again and again until we find some after-the-fact pattern in the data set. This is the significant variables, without also reporting the total number of variables that we tested that we were successful as predictors. We would be presenting a very misleading picture of our findings. Our results would appear to be far more significant than they actually were, because a series of tests such as this one just describes invalidates and conventional interpretation of a given significant level, such as 5% according to the theory of inference. How can we investigate the presence of data mining biases? With more financial data, the most ready means is to conduct out of sample tests of the proposed value of strategy. An out of sample test uses a sample that does not overlap the time period of the same on which a variable strategy or model was developed. If a variable or investment strategy is the result of data mining, it should generally not be significant in out of sample tests. A variable or investment strategy that is statistically and economically significant in out of sample tests, and that has a plausible economic basis, may be the basis for an valid investment strategy. Caution is still warranted, however. The most crucial out-of-step test in future investment success, if the strategies becomes known to other investors, prices may adjust so that the strategy, however, was tested does not work in the future. To summarize, the analyst should be aware that many apparent profitable investment strategies may reflect data mining biases, and thus be cautious about the future application of published investment research results. Untangling the extent of data mining can be complex. To assess the significance of an investment strategy, we need to know how many unsuccessful strategies were tried, not only by the current investigator, but also by previous investigators using some of the related data sets. Much research and practice closely builds on what other investigators have done, and so reflects intergeneration data mining. To use the terminology have done McQueen and Furnary. Intergenerational data mining involves using information developed by previous researchers, using a data set to guide current researchers using the same or related data set. Analysts have accumulated many observations about the particularities of financial data sets, and other analysts may develop models or investment strategies that will tend to be supported within consequences. The importance of these new results may be overstated. Researchers have suggested that the magnitude of the type of the data mining based is may be compatible with this background of the above definitions and examples. We can estimate McQueen's and Forley's 1999 cogent exploration of data mining in the context of the popular Motley Flu or the foolish floor investment strategy, the foolish floor strategy for presented in 1996 was a version of the Dow dividend strategy that was turned by the developers and exhibit for 1973 to 1993, the Foolish Four portfolio has an average annual return of 25%, and a claim was made in print that the strategy should have a similar return in the future. As McQueen and Forney discussed, however, the Foolish Four strategy was very much subject to data mining biases, including biases from intergeneration data mining, as the strategy's developers exploited observations about the data made by earlier works. McQueen and Fernie highlighted the data mining issues by taking the Foolish Four portfolio a 5.2 sampling selection bias when researchers look into questions of interest to analyze to analysts or portfolio managers. They may exclude certain stocks, bonds, portfolios, or time periods from analysis for various reasons, perhaps because the date of data availability. When data availability leads to certain assets being excluded from the analysis, we call the resulting problem sample selection bias. For example, you might sample from a database that tracks only companies currently in existence. Many mutual fund databases, for instance, provide historical information about only these funds that currently exist. Databases that report historical balances sheets and income sheets information suffers from the same sort of bias as the mutual fund databases. Funds or companies that are no longer in business do not appear there. So a study of these uses types of databases suffer from data sampling selection bias known as a survivorship bias. Dyson, Marsh, and Stunton 2002 raised the issue of survivorship bias in international indexes, an issue that has achieved a prominence in the impact of the market's survival on estimated long-term results. Markets have experienced not only disappointing performance but also total loss of value through confiscation, hyperinflation, nationalization, a market failure. By measuring the performance of markets that survive over long intervals, we draw inferences that are conditioned on survival. Yet, as pointed out by Brown, Guetzman, and Ross in 1995, Gottsman and Jorian in 1999, one cannot determine in advance which market will survive and which will perish. Survivorship bias sometimes appear when we both stock price and accounting data. For example, many studies in finance have used the ratio of a company's market price to book equities per share, i.e. the price to book ratio, or the PB. To find a PB is inversely related to a company's returns. See FEMA and French, 1992 and 2000 and 1993. PB is also used to create many popular values and growth indexes. If a database that we use to collect accounting data excludes failing companies, however, a survivorship bias may result. Kofari, Shankin, and Sloan investigated just the question: if we exclude failing stocks, then these stocks with low PB are included will have the return that are higher on average than if stocks have a low PB were included. The only advice we can offer at this point is to be aware of any biases potentially inherent in a sample. Clearly, sample selection biases can cloud the results of any study. A sample can also be biased because of the removal or the delisting of a company's stock from the exchange. For example, the Center of Research of Security Prices at the University of Chicago is a major provider of return data used in academic research. When a delisting occurs, CRSP attempts to collect returns for the delisted companies, but many times it cannot do so because of the difficulties involved. CRSP must simply list the listed companies' returns as missing. A study in the Journal of Finance by Shumway and Warter, 1999, documents the bias caused by delisting for CRSP Nasdaq returns. Another showed the delisting associated with poor company performance, e.g. bankruptcy, are missed more often than delisting associated with good or neutral company performance, e.g. mergers or moving to another exchange. In addition, delisting occurs more frequently for small companies. Sampling selection unbiased occurs even if markets where the quality and consistency of the data are quite high. Newer asset classes such as hedge funds may present even greater problems of sample selection biases. Hedge funds are the heterogeneous groups of investment vehicle typically organized so as to be free from regulatory oversight. In general, hedge funds are not required and publicly disclose performance in contrast to, say, mutual funds. Hedge funds themselves decide whether they want to be included in one of the various databases of hedge fund performances. Hedge funds with poor track records clearly may not wish to make their records public, creating a problem of self-selection bias in hedge fund databases. Further, as pointed out by Fuan and Xing, 2002, because only hedge funds with good records will volunteer to enter a database. In general, overall past hedge fund industry performance will tend to appear better than it really is. Furthermore, many hedge fund database drop funds to go out of business, creating survivorship bias in the database. Even if the database does not drop these defunct hedge funds, in the attempt to eliminate survivorship bias, the problem remains of hedge funds that stop reporting performance because of poor results. 5.3 look ahead bias. A test designed to subject a look ahead bias is used in
if it uses information that was not available on the tested date. For example, tests on trading results of a stock market returns and accounting balance sheet data must account for look-ahead biases in such tests. Although the market price of a stock is available for all market participants at the same point in time, fiscal year end book equity per share might not become publicly available until somewhat into the following quarter. Time period bias. A tested design is subject to time period bias if it is based on the time period that many may take the result of the result time period specific. A short time series is likely to give period specific results that may not reflect a longer period. A long-term series may give a more accurate picture of the true investment performance. Its disadvantage lies in the potential of the structure change occurrence during the time frame, which will result in two different return distributions. In this situation, the distribution would reflect conditioning before the change differs from the distribution we've described in the change. So here is example 7. Here's the summary. Let me read the summary. In this reading, we have presented basic. Okay, let me read the summary. In this reading, we have presented basic concepts and results in sampling and estimation. We have also emphasized the challenges faced by analysts in appropriately using and interpreting financial data. As analysts, we should always use a critical eye when evaluating the results from any study. The quality of the sample is of the utmost importance. If the sample is biased, the conclusions drawn from the sample will be an error. If to draw valid inference from a sample, the sample should be random. In simple random sampling, each observation has an equal chance of being selected. In stratified random sampling, the population is divided into subpopulations called stratas or cells. Based on one or more classification criteria, simple random samples are then drawn from each stratum. Stratified random sampling ensures that population subdivisions of intervals are represented in the sample. Stratified random sampling also produces more precise parameters estimates than simple random sampling. Time series data are a collection of observations at equally spaced intervals of time. Cross-sectional data are observations that represents individual groups, geographical regions, and companies at a single point in time. The central limit theorem states that for a large sample size for any underlying distribution for a random variable, the sample distribution of the sample mean of the variable will be approximately normal, with mean equal to population mean for the random variable, and variance equal to population variance, and the variability divided by the sample size. Based on the central limit theorem, when the sample size is large, we can compute confidence intervals for the population mean based on the normal distribution, regardless of the distribution of the underlying population. In general, a sample size of 30 or larger, 30 is the magical number. A sample size of 30 or larger can be considered large. As estimator, in a formula for estimating a parameter, an estimate is a particular value that we can calculate from a sample, but using an estimator. Because an estimator or statistic is a random variable, it is described by some probability distribution. With reference to the normal distribution, it's a normal distribution. With reference to the distribution of an estimator, as in sampling distribution, the standard deviation of the sampling distribution of the sample mean is called the sample error and the sample mean. The desirable properties of an estimator are unbiasedness, the expected value of the estimator equal to the population parameter effective. Expected value of an estimator equals the population parameter efficiency, or the estimator has the smallest variance and consistency. The probability of accurate estimates increases as sample size increases. The two types of estimates of a parameter are point estimates and interval estimates. A point estimates is a single number that we use to estimate parameters, and T estimates a range of values of brackets for the population parameter with some probabilities. A confidence interval is an interval for which we can assert with a given probability A minus A, 1 minus A, called the degree of confidence that it will contain the parameter that is intended to be estimated. The measure is often referred to as 100 multiplied by 1 minus A% confidence interval for the parameter. A 100 multiplied by 1 minus A% confidence interval for a parameter has the following structures been changed. So you have been point estimate plus reliability factor plus a standard deviation plus standard error, for which the reliability factor, we read that already. 100 multiplied by 1 minus A percentage confidence interval for the population mean of mu has a sampling variance of this and this. Students with T distribution is a family of symmetrical distribution defined by the single parameter degree or of degrees or freedom. A random sample size n is said to have n minus 1 degrees of freedom for estimating the population variance. In the same, it is seen that there are only n minus 1 independent deviations from the mean, which is based on the estimate. The degree of freedom number for use when L distribution is also n minus 1. T distribution The T distribution has fatter tails than the standard normal distribution, but converges to the standard normal distribution QS, or actually as degrees of freedom go to infinity. A 100% multiplied by 1 minus A% interval for the population mean mu with sampling from a normal distribution with the unknown variance as T equals distribution confidence intervals. It is given by this formula where TA divided by 2 is the point of the L distribution, such as A divided by 2 remains in the hot tail and S is the sample standard deviation. This confidence interval can also be used because of the central limit theorem when dealing with a large sample for a population with unknown variance that may not be normal. When we use the confidence interval of this as an alternative to the T distribution confidence interval for the population mean, we when using a large sample from a population with unknown variance, the confidence interval based on the Z statistics is less conservative or narrow than the corresponding confidence intervals of interval based on the T distribution. 3 issues in this section of the simple standard are the most the need for precision, the risk of sample or more than one population, and the expenses of different sample sizes. Sample data in investments can have a variety of problems. Survivorship bias occurs in companies that exclude that are excluded from the analysis because they have gone out of business or Bachelor of Reason are related to poor performance. Data mining bias has come his way. Look ahead bias exists in the models. Use the data if not available. Participants in the time of the market. Participants act in the model. Finally, 3-period biases is presented if the 3-period used makes the result time period of specific, or if the time period used includes a name of structural change. Okay, so here is reading 11. I do hope my readings have been helpful, and I hope to see you guys in our next reading. We'll be reading reading 12, which, if I was not mistaken, is indeed hypothesis testing, still on probabilities and statistics, but it's quite interesting. I hope to see you guys in our next video, and without further ado, goodbye.